All right, so thanks for joining me in this video. What we're going to do is we're going to share with you 5 reasons why covered calls are safer and better than only buying stocks. Now, if you want to learn more about covered calls, check out the Traders Fly website. There's a ton of stuff in there about just trading options in general and much more. All right, so let's kick things off. Let's get things started. I want to share with you kind of the covered call strategy. Here's kind of a general risk analysis profile picture of a stock or buying a single stock. But when it comes to a covered call, what's going to happen is you're willing to sell or get rid of your stock at a certain price. So what we're going to do is we're going to kind of cap it off. So say I've bought the stock at this price, okay, and now I'm willing to get rid of that stock at this price. So I'm already willing to sell it. So by selling it ahead of time or saying I'm going to sell it, I get a premium or extra capital. So that's kind of the basic strategy and the way that it works is that you buy the stock and you're saying, hey, I'm already willing to get rid of it at a certain price. Now, if it doesn't get to that price, I get to keep some of that money. But if it does get to that price, I get to get rid of it and I still get to keep that money. The downside is if it gets to 200 kind of over here, then in that case, well, I don't make the premium or the extra income that I would have made from it moving up to 200. I have to get rid of it a lot sooner, maybe at around 160. So, but beyond that, most of the time, as long as the stock doesn't explode to the moon, you should be fine and okay. And if it pulls back, you get to make some extra money. So that's kind of some of the big things here that we're going to talk about right now in this video. So you can basically make more money from time decay. You can make more money in general, lowers the risk of entry. You can protect yourself on your position a little bit more. And then also, if the stock goes against you, that's part of that protection. And it spreads the risk of your portfolio, you know, doing different strategies and concepts. All right, so let's go ahead and cover number 1 here. And that is how you make money from time decay. So if we look at just options in general, okay, and you're looking at covered calls right here. If we look at just options in general, with time, what happens is there's a decay curve. So as that time gets to 0, you basically decay the option. So it's kind of like insurance premium. Let's say you own it for 30 days or you pay for cable or internet or water. After about 15 days, well, it's about half of that value already. So you might be moving, well, you get a credit and so on. So that's the same thing here is that, okay, well, you're letting things decay partly, and then you're either getting out or letting it decay. You're selling a service of, I'm going to sell my stock. You're selling a commitment of that. So by doing that, you get a decay, and that decay speeds things up as it gets closer and closer towards expiration. Now, I'll show you kind of an example here as we look into Apple here. Okay, and let's take a look at Apple. So here, this stock, what I have is I'm down $260 since I bought it. I bought it at 162.17. But this call that I have that I sold, I said, hey, I'm willing to sell that stock at 172.50 and I get to make $38 from it. So by doing this, right now I'm up about $26 on that. Now remember, I'm losing $248 on the stock value, but I'm making some extra money on that call. So I'm actually only down $220. Okay, otherwise it'd be down $238. So by doing that, I get to make a little bit of extra money, and that time decay continues to work in my favor. So you can see right here, okay, that time decay, every day that that stock stands still, I make about $3.24. That's the theta. So that white line will get closer and closer to the green line, and that's the decay. The expiration is the green line. The white line is today. And right now we've decayed quite a bit and moved in my favor. So we are profitable by about $26 on this call contract. Yes, we're losing on the stock, but we're profitable on the call contract. Now, as far as looking at our making more money concept, well, here's the part where you can go ahead and look at if the stock continues to head higher and we get to a higher zone or region, like let's say we get to this region, well, I've made profit from the stock, but I've also made profit from the covered call because here is kind of where I lose the stock. So as long as I'm in between this range, okay, I'm profitable on the stock and I'm profitable on the covered call. So I kind of make a little bit of extra money. And if you get a dividend, you get even more money, right? So that's kind of a nice sweet spot. All right, so let's take a look at item number 3. It lowers your risk of entry. Okay, so here is, if we go ahead and buy a covered call right now, just to show you buy covered stock. Okay, so here is, well, let's do it this way. Let's buy 100 shares, and then we'll do this order. Okay, buy a single. Okay, so what we'll do is we'll do this together. Okay, so you can see this 100 shares and selling the stock at 160, which is not too far away from now. But my cost of entry here is basically about, let's see, cost of order 1, cost of order 2. It's going to combine it. And let me actually combine it for you so you can see it. It's going to be right here, buy, just it'll be easier to understand from a basic standpoint. And then we can delete these other example trades. Okay, so from a cost basis, if we look at this, okay, this stock would cost me $15,330 because remember, I'm making $670, I'm making about $600 from the premium of that. But if I go ahead and buy the stock outright without that, it'll be $159.37 times 100. So that's a bit of the difference here. Let's delete this and just buy the shares, switch to 100. Okay, you can see it's 15,937. Okay, versus buy cover. Okay, delete that. And then this one is 15,338. So 15,9 versus 15,3. You can see there's a bit of difference, and that is the premium, that $600 of premium that I get to make. So you get to have a lower cost of entry because you're already willing to sell the stock against your position. Now you can protect your position if it goes against you as well. So just like I showed you earlier, if this stock continues to pull back, well, right now I get to make, 26 bucks. It may not seem like a lot, but with time, that could continue to add up a little bit here, another 20 bucks, another 20 bucks, another 50 bucks, another 50 bucks. And you could also sell things closer, because I sold this one further out, but you could sell it closer to where we are in the price, and that'll protect you even more. So that could give you another $100, $100, $100. So now if the stock pulls back, okay, instead of losing 262 right here, or, I would have lost basically 280. So what you're doing is you're capping some of the losses a little bit, so that way you're not losing as bad or nasty. Okay, and the other thing is it spreads the risk of your portfolio. So if you're only doing kind of like one strategy and just buying stock on their own, now you could spread out the risk. You could do covered calls. Later on, you could sell puts. So you could start mixing things in, and then eventually maybe you'll get to iron condors, verticals, butterflies, calendar spreads, and much more. But the point is you're not making money just from one thing, okay? Because most people, what they do is they buy stock and that is it. In this case, what you're doing is now you're spreading your capital and risk into different segments, different strategies, and they operate a little bit differently. So anyway, I hope that helps and gives you some insight on these 5 reasons why stocks, selling covered calls is a lot better than just doing stock on their own, but just gives you some insight and perspective there. So if you're interested in joining me and checking out some of the other things I have available, feel free to check out the tradersfly.com website, or take a look at some of the one-on-one coaching and mentoring that I also offer, as well as some great courses on covered calls as well. All right, thanks again. Enjoy the rest of the day ahead.